Into Friday, most of the more actively traded markets are confined to within 1% of weekly opening levels. However, with that said, the moves that fall outside of this have been notable, and some of the moves on the inside of this should not be overlooked for their subtlety. As far as the markets that are more than 1% away from weekly opening levels go, it's the U.S. equity market that takes the cake here. The S&P 500 is up some 3% since things got going this week, with most of the move driven off the U.S. midterm election result, which the market seems to be taking as a positive on an expectation that with the Dems taking the House, it will put the brakes on the administration's populist ambitions and welcome a de-escalation of trade war tension. We are not as convinced of this, nor are we convinced that any of this will factor as much into a market likely to be far more sensitive to interest rates and inflationary pressure than politics. On the currency front, it shouldn't then come as a surprise to see the New Zealand dollar as a currency that is up over 1% since the weekly opening levels, with the risk-correlated commodity currency benefiting from the run in stocks, but also getting an added push on some well-received economic data out of New Zealand. As far as the underperformance outside of the 1% range goes, it's gold that takes the cake here, but only just down about 1.2% on the week at the time of this update. And yet, the one we find most interesting is one that is tracking lower by not even 0.5% since the weekly open. The one that we're talking about is the euro, which despite the close proximity to weekly opening levels has managed to give back all of its gains since trading up to about 115 and now sits at the lows of the week, once again within striking distance of another test of that 2018 low from August, already retested and kissed last week before a nice recovery that is now at risk of being compromised. The underlying weakness seems to be coming from a number of fronts, none unfamiliar with the dovish-leaning Draghi comments, some downward EU growth forecasts, Italian budget drama, and post-Fed dollar rallies all playing into the euro pullback. This sets up an interesting Friday, as the weekly close here could make a big difference as far as how the market perceives the euro and the state of the FX market over the coming weeks. If the euro extends declines down below 113 to fresh 2018 lows, it could very well inspire another broad-based run in the US dollar. If, however, the euro manages to find its footing before the day is out and closes the week back in positive territory, it could set up the start to a major sell-off in the dollar. Of course, we are speaking on a broader level here, and what happens in the UK relating to Brexit could be one of those things that drives the pound to break away from trading within the pack. Overall, we still see the greater risk for the next big moves in markets to be for another big downturn in stocks and the start to a greater decline in the US dollar. With stocks, we don't believe the market has done a good enough job pricing in the negative impact of policy normalization. With currencies, on the other hand, we think the market has indeed done a good job of pricing in Fed reversal, which leaves room for a dollar sell-off on any signs of a less aggressive Fed normalization timeline. Moreover, despite the results in the U.S. midterms, we still think the administration will try to push forward with its soft dollar trade policy, which could be yet another thorn at the buck's side in the months ahead. Looking at the Friday calendar, it's UK data that stands out, with the market taking in industrial manufacturing production, trade, and GDP. Later on in the US, we get producer prices and Michigan confidence. That's all for now.